put $15,000 out of that fund into the seed of Snapchat. And it grew. It was eventually worth 34 million. There was a time when Facebook wanted to buy Snapchat. That's a story that's been told by Evan many times. And I think it was around $3 billion. And we're thinking, my God, $3 billion. And the high school's like, $3 billion? This would be great for us. The nice thing about venture capital is that you can only lose your money one time, right? And we do. And we've all lost, most of us have lost one time our money multiple times. When you get a Snapchat, we made 2,250 times our money. I still think machines will replace a lot of white collar jobs, including venture capital. It's a have and have nots world. So don't get too wrapped up on price as a VC. It's harder to fix a bad team, and a good team can fix the product.
Just go and do it and see what happens.
Ideas are worth like jack shit, absolute jack shit. Like if you can't execute, there's nothing.
Just take that initiative to actually take whatever crazy ideas that they might have and just try to see what comes of it.
Don't be afraid of ambition. Chase it, love it, wrap your arms around it and say it out loud.
New Zealanders don't know any better. They will just get up and give it a shot. That's why we were first to get to the top of Mount Everest.
Go to dream that ultimate dream. Like, what is it that you ultimately want to do? And it's all achievable.
Great. Well, thank you so much for joining us, Barry.
Great to be here, guys.
Yeah, you're founding partner of Lightspeed Venture Partners, one of the most iconic venture firms in the world. But you grew up in Silicon Valley in California, and for many generations, your family has been there. I'd be curious about how you saw the transformation from what was a beautiful kind of countryside to what is now Silicon Valley.
Yeah, I grew up, I'm a fourth generation Californian. I grew up in the Bay Area, born in Oakland, but I grew up in Sunnyvale, which is almost the heart of the Silicon Valley. And when I grew up, though, was a lot of orchards, cherry orchards and apricot orchards, and really no tech businesses. Lockheed was there, and tech hadn't really started. So, tech started in the sort of the 70s, and obviously over time became the center. And it brought a lot of opportunity. It brought a lot of wealth to the region and jobs and of course, density. House prices went up and everything became a little more expensive to live there. But that's sort of what you pay for when you have the opportunities that you have in the Silicon Valley. But it's definitely changed a lot. It's a very different place than it was 50 or 60 years ago. I sort of miss the old times, by the way. I love what Silicon Valley has brought, but I sort of miss the old days.
What do you miss about it? The countryside or?
Less traffic. People were a little chiller. It's sort of an easier going life. Northern California is beautiful. It still is, but it was less dense, right? There were less houses everywhere and you were a lot more places where you can just sort of hike and bike and do all that kind of stuff. And fortunately, we've preserved some of those places, but it's a beautiful part of the country too. It's not just, the heart of Silicon Valley.
You said you didn't realize you were a builder until later in life. When did that click for you and what made you see it?
Yeah, it's interesting because I wonder when people actually realize that they are builders. And it'd be interesting for you to ask the CEOs in your portfolio when they first discovered it. Maybe it was in the womb. It wasn't for me. I always thought that I wanted to go and be an operational person and go into a large company and sort of, escalate throughout the company and become CEO or whatever the role is. But the old corporate sort of ladder. And it's funny, when I went to Stanford Business School, I got more of a taste of sort of entrepreneurship there. And then I went to Cisco and I sort of went to a company that had just gone public. It was growing really super fast and got a taste of what an entrepreneurial culture felt like. And I realized that Cisco got bigger. It went from 400 people to 12,000 people. It's like I felt way better at 400 than I did at 12,000. At 12,000, it became more of a corporate culture. There were politics and people building organizations and all that kind of stuff. And I just wasn't very good at that. I was more focused on just, sort of getting results and getting stuff done. And so, that made me think about, what I really wanted to do. And fortunately, I had a classmate from business school call me about venture capital. And I'd never even thought about doing venture capital. I didn't even take the class in business school, but I thought, venture capital means you're working with a bunch of small companies. That sounds interesting to me because I really like the smaller companies. And so I learned more about it and eventually started and took the job in venture capital in January 97. And then in 2005 really is when we broke off and started Lightspeed. And that's where I really discovered, entrepreneurial. People don't think of VCs as entrepreneurial, and maybe they're not, and versus CEOs. But in terms of building a firm and starting a firm, there's a lot of similarities, and there's a lot of roadblocks and hurdles you have to get over. But it's also exhilarating, much like building a company is. So I probably learned around 2005, early 2000s, that I probably was more of a builder than a manager, so to speak.
Yeah.
Getting stuff off the ground, right?
One interesting unexplored kind of angle that I think I'd be really curious to learn about is, and I found this through some of the research that we did, was that you actually helped build Cisco's M&A machine. And I'm curious how that shaped your investment thinking.
I started doing M&A at Cisco. There were people after me that, like Mike Volpe and others, who's also become he's a very good VC now, but Mike did a lot more of the deals than I did, and helped, sort of build that thing out. But I got a chance to do the first 3 acquisitions for Cisco, and got a feel for what startups were all like, and got to do some deals and investments also in companies that were startups. And that was fun. It was a lot of fun. It was like you're betting on these companies to emerge and, be major players in markets. And I found that exhilarating. So that gave me a sense that maybe, I would like being an investor. And I think that's also why my classmate called me, because I was doing investments in companies, and maybe it translated to VC.
What was it that you enjoyed about that?
I like the uncertainty. I mean, let's face it, when you're a public market investor, there's not much uncertainty, right? You're sort of betting that, on trend lines. In private markets, there's a ton of uncertainty. How good is this team? Is this market really going to emerge? Can we unseat the legacy players? Can we change the game? Can we disrupt the market? Is the technology going to work? It's all that stuff that I find interesting. And I think that's, if you're a VC, I think if you're not excited by that kind of stuff, you're probably in the wrong business.
You started your VC career at a really interesting point in time, right? Late 90s, early 2000s, when the Dotcom bubble crashed. Yeah, very contrarian time to kind of go into VC and start a firm. How did you think about that when you lived through that time?
That's funny. I sort of went through a whole cycle in about the first 8 years of VC. In 97, the January 97 is when I started, and that was the Sienna IPO, which really started the optical boom. There's the optical boom, the telecom boom, and of course the internet boom that all sort of came together in the late 90s. And there were a lot of good outcomes, right? A lot of IPOs, a lot of big acquisitions and companies, and you'd have them very fast. So I think we all felt like this was an easy business to be in. If you started in the late 90s, you felt like this was easy and you were good at it. And then the dot-com crash and telecom crash in 2001, 2 came, and nothing happened, and a lot of things went to zero. And then you realize, wow, this is really a hard business. And in 2005, when we started Lightspeed, we sort of looked around, and a lot of the people that were, major players in venture, the firms had changed. Either people had retired, or they went through generational transition, or they just shut down the doors and said, well, nothing's going to happen. 2005, it was probably one of the slowest times in venture. I think there was probably something like $10 billion a year coming into the venture capital industry. That's one round now for Anthropic or OpenAI or someone like that, right? So, and we sort of decided that, hey, we were gonna break off and start Lightspeed and really focus on early stage, because that was we thought the most important real estate in ventures, like the first money in, getting in early, taking that high risk, getting high ownership, and being part of building the company. So that's what we set out to do with Lightspeed. And of course, you can ask me then what happened after that, but in 2005, you go from 2005, where maybe 10 billion a year is coming into venture, to now it's 300 billion plus. It's probably more than that now. You think about, in 20 years, the industry has grown probably 30x. And what were the things that drove that growth, right? This is sort of important to understand about venture. Venture capital, people say it's not venture capital anymore. Well, it's very different. There are different flavors of venture capital, but back then it was more of a craftsman industry, right? There weren't big funds. You were backing companies and you were helping to build them. But 3 things really drove the growth. One is tech became way more important part of the world economy. Right? If you go back to 2000, the top 5 market cap companies, none of them are tech. They're mostly oil companies and Berkshire Hathaway. Today, they're all tech, top 5 market cap companies. Number 2, it became a global business, right? So whereas in terms of the companies that we are investing in, most of the companies were not only in the US, they're mostly in the Silicon Valley back in the late 90s. But now more than half of the unicorns are outside the United States because of regions that are developing, like New Zealand, right? And this is good. This is all good for everybody. We need more entrepreneurship everywhere. And the third thing that happened was companies, of course, stayed private longer, right? So whereas Amazon and Cisco went public at $300 billion valuations, that's an early stage round now. And you have companies doing, rounds above 100 billion, right? And you have companies like Stripe and SpaceX and others that have just stayed private very long because they can keep doing secondaries to get liquidity. So that creates an opportunity. So for Lightspeed, what we did is we basically followed those opportunities. We went global, we expanded across other investment sectors, and we developed later stage funds. So we sort of grew our funds alongside the industry. That was a long answer.
Do you think that to your point of you seeing Silicon Valley from its nascency to now, does that give you a perspective on what it looks like to build similar ecosystems in other places, for example, New Zealand? And are certain countries better, more well suited? Obviously, you have the network effects of Silicon Valley. How easy is it to replicate the success that's happened there?
I've had a chance to see the Silicon Valley. We've had an office and been investing in Israel since the 90s. That's another country that's, if you've probably read Startup Nation, but it's a country to sort of model and understand how they did it. And then there's other countries that are now trying to do that, but they all have sort of similar characteristics, and it takes time to get the flywheel going, right? You usually have a good pool of universities and people coming out of universities. You usually have some level of infrastructure, like for manufacturing or producing things. And then in some cases, you have government assistance. Israel was really strong on helping companies get through that funding gap that happens when you're just getting an ecosystem started. You might see it in New Zealand. The nice thing that happens is once you get to entrepreneurs starting companies for the second or third time, it really takes off. Because the first time entrepreneurs start a company, sometimes they'll say, okay, we can sell this thing for $100 million. That's a big outcome. I sort of want to do that. And as an investor, well, we might be able to go for more, but I understand if you want to do that, that's what's going to happen. But the second time they start a company, they say, no, I've already sold for $100 million. I'd actually like to sell for 500 million or $1 billion or more. And all of a sudden, then you start to see bigger companies getting built. We've seen that in Israel, and I think we'll see that in other geographies. And hopefully you guys are starting to see second-time entrepreneurs in your ecosystem.
Yeah, absolutely.
Do you sometimes miss the kind of craftsmanship early days of Silicon Valley versus what is now a kind of big industry, big money? Are you sometimes nostalgic about that?
Yeah, I mean, we sort of go through different stages in venture about every 15 years. And if you go back to the sort of late 80s, it's more of a craftsman stage, sort of the 80s to 90s, it's more of a craftsman stage, small funds, working with companies through an IPO, staying on the board, helping to build it. You go back to some of those VCs, they're wonderful VCs, and they're very operational and they're very helpful to companies. We then went through and sort of starting in, I would say 2000 and maybe 20, more of a, maybe 15, more of a sort of a scale up phase, right? Where we started to grow our funds and the venture and companies were staying private longer. And then starting in 2020 or so, we've been more in a specialization phase where you see that our funds are specializing by either geography or sector or stage. And in some cases, you got firms like us and our peers that do everything across geographies and sectors. And so you have the big, large mega funds, and then you have specialist funds. Everyone's trying to find an angle, and everyone's trying to figure out what their sort of niche is. And when a market grows from $10 billion to $300 billion, like venture capital has, there's lots of segments. So when people say a VC is a VC is a VC, no, they're not. Someone who's an early stage VC writing the first check, helping to build companies is very different than someone who's writing checks into $50 billion valuation companies, right? They're almost more like public market investors in a very different skill set. So the market's really grown and it's segmented, and there's a lot of market opportunity for everybody. You just have to figure out sort of where you're going to target.
Can I ask one question on that? Maybe double click. I mean, I've heard a lot of people speculate that VC is a little bit oversaturated and that there's not a lot of room for new and emerging managers. What you seem to be saying is the opposite, which is that actually if you specialize, as the market grows, there's a lot more niches that you can fill. Maybe you're going to be capped in how big those niches can be, or maybe not. Maybe as the whole market grows, you'll grow alongside with it. Is that what you're saying? What's your perspective on that?
No, I mean, I don't know that, there's always new firms being created and there's always firms that are going away. I do think that you have to think about how defensible your strategy is as a venture firm. And, I think there's a number of early stage firms that have really good deal flow, proprietary deal flow, whatever you want to call it. They're good at picking, they're focused on a certain sector or geography, and they're very, very good at it, and they generate great returns. That's, to me, defensible, right? They're going to have competition, but at least you know how to defend. On the other hand, then you have firms like us and our peers who are very large, and we work from early stage all through growth. We work across sectors and across geographies. That's also defensible because it's really hard to get there. It's like you don't wake up and say, okay, I'm going to, raise $10 billion or whatever you raise as a big fund. It takes steps because every time you grow a venture firm, you're investing in something, right? You're investing in people, and it takes people all have a J curve. We know about the J curve in a venture fund, but every person you hire has a J curve. That is, you pay them a long time until they make you any money. So anytime you go to a new stage, new geography, new sector, you're always adding people and you're investing in, and you have these J curves. And so it's really hard to get to a place where you can have that kind of capital management. It's defensible, right? It also means that you can play in rounds that smaller funds cannot play in. In some cases, these are the first institutional rounds are being done. So that's defensible. The early stage is defensible. I think in the middle is a little more tenuous, and you have to be careful there because you're at risk of having the early stage guys move up or the real big guys playing and moving down. That's sort of the way I look at it today. There's plenty of room though for new people, to start, especially in that early stage. And I think we might see some of the people who are in the middle stage try to get to that large size so they have more staying power.
Yeah. I want to start talking about the Snapchat story. It's a story that I think you've told many times before, but we have many listeners, entrepreneurs, investors in New Zealand, Australia, who might not be as familiar. And I think it tells you a lot about how you personally think about investing and what drives your investment decisions. So yeah, there's this famous kind of story about the kitchen table moment when you first came across Snapchat. Could you tell us, more about it and how it all came about?
Yeah, it's 2012. My daughter was a sophomore in high school. And if you know anything about sophomores in high school, they have a lot of different qualities. They're great, but they also bring a certain set of challenges as a parent. Well, she came home from high school one night and brought a bunch of her friends, and they were sitting around our kitchen table and they were all on their phones and holding their phones in front of their face. And I'm saying, well, and these were iPhones. And I said, you guys are all here. Why aren't you just talking to each other? I mean, why did you all, and they were like, my daughter's like, well, Dad, we're playing this new game and, this new app and everyone's using it. And I go, well, what is it called? And she goes, what's called? Snapchat. And I said, well, what does it do? And so she says, well, you take pictures and you send them to your friends and then they disappear in 10 seconds. And I think, well, what kind of pictures are you talking about? And she said, well, no, not those kinds. It's just fun stuff between friends, and you're sending to a small group, not broadcasting it. And all the girls are like, yeah, we all use it. It's like the most popular app in high school with Angry Birds. And I said, well, how often do you use it? She said, well, when we first started, I used it like 5 times a day, but now I probably use it 30 times a day. And her friends are nodding their heads. And I'm thinking, well, that's an awful lot of usage. And my son was there and he said, yeah, the boys use it too. So, everyone's on this app. And I'm thinking, well, here we are in 2012, January 2012. There's this app that a bunch of high school kids are using and no parents know about it. So that's sort of interesting. So I took that information back to my team and I said, hey, anyone hear about this thing, Snapchat? And no, people are like, no, we haven't heard about it. It turns out my daughter's high school was one of the early adopters, like the first 50,000 users. So a week passed, and then I kept asking, and some of my partners were like, yeah, you know what, our kids are using it too. A week passed, and finally, one of our partners, Jeremy Liu, was able to connect with Evan on Facebook. Actually, Evan Spiegel on Facebook, of all things. And Evan came in for a meeting after that. And we met with him, and he took us through the pitch. Here were these disappearing pictures, and it was growing from 10,000 to 100,000 users in 2 months, which is, we thought he would get to 1 million pretty soon, and it was very viral. And the daily over monthly usage was very high, over 50%, and and had all the profiles of something that could take off. Evan was raising $500,000 because his dad was paying for storage, in Amazon, and he didn't want to pay it anymore. So we said, well, we'll give you $500,000. So we did, and we bought a little more than 10% of the company. But we also, there was a venture fund that I chair at my kid's high school that's been going for, I don't know, 10, 15 years. And it goes to teachers, and we put that fund in the seed of Snapchat. We put $15,000 out of that fund into the seed of Snapchat. And it grew. It was eventually worth 34. And so we'd use that to pay teacher bonuses over a long period and invest in the school and infrastructure and all that kind of stuff. So, it's a fun story. It goes to show you, though, back then in 2012, it may not seem that way, but people didn't take college kids seriously as entrepreneurs. And Evan was in college, but people didn't take him seriously. And now, of course, he's grown into just a fabulous CEO, and he's shown how much he could scale, like some of his peers, a small amount of his peers. And also the fact that it came from my daughter, and I'm an enterprise guy, so I didn't know anything about consumer. It came from my daughter, and it's like, you think about it, we all think that the best deals come from, we can tell what sources they come from. They come from these type of sources, but you never actually know. Sometimes the best deals come from just out of the blue or different things. So you got to pay attention when someone brings you a deal, and you got to sort of attend to it and really, do the diligence to make sure it's not something, that you're missing. That was my lesson from that, is like, anyone can be an entrepreneur anywhere at any age, and take references, referrals, seriously, because you never know when, if we would have said, forget that, it's a stupid app. That was my first impression. It's like, why would anyone want to do that? Well, I'm not the target user, right? But then, and so a lot of lesson learned from that one.
There was an interesting kind of detail that you skipped over, which was that you guys could initially find how to connect with Snapchat, right? And Jeremy had to do a who is lookup, and he found Toyota Group, which was the street that Evan's dad lived on, and then he found him through the Stanford Alumni Network. Walk me through that whole.
Yeah, Jeremy. The pitch they gave was for Toyota Group, which became Snapchat. But Jeremy did some good sleuthing. And I kept saying, guys, we got to find this thing. Like, this thing is growing and no one knows it. So Jeremy did some good sleuthing and on Facebook and mailed Evan on Facebook. And I think the fact that Jeremy had Obama on his Facebook page or something. So Evan responded to him for some reason. Anyway, a lot of fortunate stuff happened for us there. And of course, there was a time when Facebook wanted to buy Snapchat. That's a story that's been told by Evan many times. And I think it was around $3 billion. And we're thinking, my God, $3 billion. And the high school's like, $3 billion? This would be great for us. But, Evan had different plans. And of course, he was right.
And you wrote that check in 10 days from never hearing about it to.
We wrote that check very fast. Yeah. I mean, we did a lot of seeds, right? It was a seed check. Back then, a seed was $500,000. And so we had a different process. It was a faster process. By the way, we didn't all agree that we should do it in the partnership, right? It was somewhat controversial, as you could expect, but we have a lower bar for seeds. Like, 2 partners can sponsor it. And we had enough support in the partnership. We said, let's go do it. And we did it.
When did you realize that this might be something huge, and what gave you that conviction? Or was it just a lower bar and it was kind of good enough?
No, I think, when you do seeds, right, you want to put money, sprinkle money across things that you think could be interesting. And we thought, given, again, this is an app that we, had 100,000 users when we invested, fantastic growth. All the metrics were, were in the right direction, and it was very viral. They weren't spending any money on marketing, and it was, I mean, we did it at 4 or something like that. I mean, that's like a New Zealand valuation right now. So you should do as many of those as you can, but it all aligned for us. And the nice thing about venture capital is that you can only lose your money one time, right? And we do. And we've all lost, most of us have lost one time our money multiple times. But, when you get a Snapchat, we made 2,250 times our money. And those make up for the times when you lose, all or part of your money. And that's the beauty of venture capital. We're making bets, right? And that's changed. We can talk about how it's changed, but the strategy in venture has changed, I think, quite a bit to where it is today.
How has it changed?
So back then, and this is I'm talking about an early stage fund, we thought about venture as building a portfolio of a diversified portfolio of investments, right? So they were mostly the same stage because it was an early stage fund, but they were in different sectors and potentially even different geographies. But it was very diversified. You might have some common themes across some companies, but generally you're placing a lot of bets, call it 40 to 50 bets in companies. And today, and that was the way you do it because that was just how venture was thought of. But today, I think there's some studies that I've seen certainly that will tell you that concentration is in fact maybe the more important thing in today's, venture funds, is that it's not about necessarily having a wide swath and, broad set of companies and then having 2 or 3 of them hit, which is, sort of what you need to drive a fund, but it's placing some bets, figuring out as quickly as possible which one of those are really getting serious traction and trying to put as much of your capital into those companies, right? Concentrating capital into those companies. And the reason why that strategy, I think, is come about, and studies have shown that you outperform when I think you do that. For instance, a large concentrated fund may outperform a small diversified fund. Everyone thinks fund size is related to performance. It's actually not. It's more about concentration than it is about fund size. So, paying attention to that. And the reason I think it works now is because you have the haves and have-nots. We live in a world where we have companies getting, $1 billion, $10 billion, $100 billion, $1 trillion valuations as private companies. And we have companies that can't get funded or are struggling to get funded, right? And so just like we have the Mag 7 in the public markets, we're going to have the Mag something in the private markets, called the Mag 30 or whatever it is. And if you're in one of those 30, you want to put as much capital as you can into those companies. And that's how you drive great returns.
And why has that changed since before? Like, did something fundamentally shift in the market to make that strategy more favorable now?
I think it's the pace at which companies are now able to grow and the valuations that are attributed to that growth. So now, doubling and tripling used to be really good growth. And now we're seeing companies 5 or 10x, right? Part of it's AI driven. Part of it's just the new economy and sort of disruption into markets. But when you look at the companies that have achieved $100 billion valuation, I mean, if you're in at any stage, you can put a lot of capital into those companies and generate very good returns, whether you're a small fund or a large fund. And so being in those companies is really important. And even if you're not in the beginning, trying to get in later is really important. And you can see that when you look at how many investors are in some of these very notable and iconic companies, private companies.
You have a framework for this, right? You call them learning bets or something, like where you make small.
Yeah. Yeah. I mean, we used to call it thesis investing, and we still do it, but thesis investing is just you pick a thesis and you make a learning bet. A good example is you go back to like 2006 or 7. We thought flash memory could be important to storage, could disrupt storage, enterprise storage. And so we made a bet in an SSD company. And we learned from it. And we learned that, hey, this is going to happen. This is definitely going to disrupt storage. And there's a whole bunch of opportunities. And we started to make bets across the market. And we bet on people like Nimble Storage and Extreme IO and Nutanix and Fusion IO and a bunch of companies like that. And we built a portfolio of about 15 companies. And I think that portfolio delivered about a 10x total. So if you can get in early, I mean, and the key learning here is in venture capital, you just don't make money when you're with the herd, right? You just don't, it's hard to make money when you're with everybody else, right? So you have to be early into something, whether it's a company, a geography, a sector, you name it. You got to be early. And in some cases, you're going to look stupid. But like I say, so you lose one time your money. Sometimes you're going to look really smart, but you got to be early. And that's sort of what's driving, if you look at a lot of the work now, we are actually in markets where venture capital in AI related markets where we're now starting to fund 4 or 5 companies into a market. We know that that's a mistake. We know that 4 or 5 companies aren't going to win in a market. Maybe 1 or 2 win, but we fall into the same traps as VCs. We want to be in the market. We can't get into the right company, so we start our own company. You might as well just say, I want to be in the leader, get in the leader, put your capital in the leader, and just go along for the ride.
Yeah, and at the moment we're living through a very interesting moment, which is the AI moment, and Lightspeed is in a few big AI companies like Anthropic and XAI. Does this feel like maybe 2012, like the social media moment? Is this bigger? And what's everybody getting wrong about this moment?
Yeah, I mean, it feels pretty big to me. It feels bigger than anything I've seen. And maybe that's just because of the growth that we're seeing from some of these companies, how fast and how large they're growing, and the amount of capital they're raising at the valuations they're raising. But it feels very different than 2012 or any other. It feels also very different from 1997 in that bubble. AI is an important disruption. It's an important technology. It might be the most important technology, in the last 50 years. And so people are really trying to understand, where they need to place bets. As a venture capitalist, you have to place bets. You can't sit on your hands. You got to place bets. And there's a whole bunch of industries that may be disrupted by AI. There's also, of course, the core platform companies. And don't forget robotics, right? Because robotics is also driven by AI. So, we talk a lot about the AI companies being sort of the darlings, and they are. The platform companies, they are sort of the beginning, and then we'll have application-oriented companies. But we're also going to have robotic companies, and the robotics companies, I think, will be the next leg where we'll say, wow, some of these companies have achieved incredible growth in revenue, selling to industrial companies or whatever, right, who have a lot of money, and we'll see some valuations start to, you know, go into the stratosphere in some of those companies too. So, if you're a VC, this is a great moment to be a VC. You just have a lot of competition, right? I mean, it's great. It's a great, sort of disruptive technologies. It's new technologies. It's changing everything. Every sort of, market is up for grabs. You just have to figure out which companies you're going to be in and get in them. And if you're an entrepreneur, what a wonderful time to be an entrepreneur, right? I mean, you can disrupt anything now, and you can write code so fast now with the tools that are available through AI. You can build companies much less expense than you could before, get them to market faster and scale revenue faster. Nothing wrong with that.
Do you have a vision for the world, for what the world looks like once all these AI and robotic gains have been implemented widely in every industry?
I mean, no, I don't. I think you have to look at the future with optimism, but also some fear, right? I think it's healthy to have some balance of fear. The optimism is that the productivity that we can create for people, can we accelerate, in certain inventions that serve mankind? Can we accelerate healthcare that serves mankind? Can we do things that just create a better world? At the same time, the tool can be used by anybody to do harm. And there's also the discussion about job loss. And so I think there will be job loss, and there will have to be, we'll have to figure out where we create jobs to offset the jobs that are lost, or how do we deal with that? And I don't think anyone's ready to do that. Maybe New Zealand, because you guys are such a creative and innovative country, you can figure this out before anybody else. But I think it's coming, and we all know it's coming, but I haven't seen any great solutions yet. That's something to be a little bit scared about. And you see the people running, the large AI companies saying, hey, we've got to be careful about how we train these machines and what we allow them to do and all that kind of stuff. So, there's obviously the debate about, should there be government guardrails or not? I don't know, but we have to be really thoughtful about how we use this technology.
I think you've spoken earlier about AI eventually replacing pretty much all white collar jobs, including investors. Does that magnitude of change scare you? And what do you tell your kids about what career paths they should be pursuing?
I said that in 2019. Actually, I wrote a blog in 2020, and one of the things was machines would just replace a lot of jobs, including venture capital. And I still think machines will replace a lot of white collar jobs, including venture capital. It's interesting to think about what that means. From a education standpoint, I think we should not be afraid to let kids learn to use AI. It's not cheating. Let them learn to use AI and be more productive with it. They still need to understand the basics underlying problems they're solving, but let them learn how to be really good at using AI to be productive in the world that's going to come, which I don't think anyone really knows. Maybe Elon knows because he's got the best crystal ball available. But I think there's also jobs. 5 years ago, people were saying, hey, your kids in college, have them be CS majors and learn how to code. And now people are like, well, I'm not sure there's a lot of jobs for CS majors because it's become so easy to code. Machines can do it for you. Now, what do we know? We know there's probably still opportunities for electricians and plumbers and contractors and all that kind of stuff until the robots come. But I think that the most important thing is we teach people how to use AI to be more productive in their lives and in their work. And maybe that creates more opportunities for people to do things that then add to the global GDP.
What are you telling your kids? How old are your kids? What are you telling them to?
My kids
do?
are in their late 20s and 30s. My daughter, the Snapchat daughter, is in her late 20s. Yeah, I tell them the same thing. Learn how to use AI and find a job that you feel like it adds a lot of value. But kids these days, they don't stay in jobs for 30 years. They move around.
Yeah.
I think I've had 3 jobs since college, and people laugh when I say this, but that's sort of how, we were brought up. And now, my kids seem to switch jobs about every 3 or 4 years. So,
Yeah.
and that's pretty common, right? Certainly common in the Valley.
And just to double click on whether your job or our job as venture investors will be replaced, we talk a lot about emotional intelligence in investing. Yeah, how much do you think that will still play a role versus kind of just, a machine crunching the numbers and seeing daily active users, monthly active users growing and then making a decision based on that?
Yeah, where can AI be helpful today? It can be helpful in assessing companies, understanding markets, understanding the player competitive landscape, all that kind of stuff. It can do that work for you really quickly. It could also help you understand really how companies are doing. If you take board packages, then you load them into Claude and start asking the right questions. A lot of times around the partnership, people are talking about their companies in a way that it's like their children, and they tend to sugarcoat. But if you put it in AI, you actually get, here's what's really happening with this company and here's what they need to be doing. That's all stuff that's good for venture capital. And over time, I think there'll be more uses within venture capital and financial services. Having said that, there is a part of the business that is relationship driven and EQ driven. And especially in the early stages when you're building companies and you're helping people out and entrepreneurs out, I think that's a skill set that's going to be harder to replace. So it's one worth developing. But I do think venture capital firms are going to end up being smaller from the investment side in the future, because I think AI will replace some of those jobs, especially starting with the lower level jobs, but working their way up over time. Why shouldn't we ask the machine to vote on every deal? If the partners are voting, what does the machine think? Give them all the data, or her all the data, and ask, would you make this investment or not?
Yeah.
And I think a lot of firms are doing that now.
Yeah. And just looking back at all the investment, you've made thousands of investment decisions over the last 30 years. Do you think there's something about gut feel versus, data? And do you think you would have probably missed some opportunities if you had followed whatever machine would have recommended?
I think they're both important, right? And you see investors that rely primarily on data, and you see investors that rely primarily on gut feel, and you see some that rely on both. And I think those are probably the better. Some people are better in their gut feel, but gut feel really is a combination of experience and instinct, right? And intuition. And so, I've certainly met and worked with, some investors just had incredible gut feel. And it's funny because when you go to a partnership and you vote on deals, it's almost like the unanimous ones are the ones you should question whether you should do them. It's the ones that are controversial that are probably the ones you should do. And we went
Sure.
back and we looked at it and we sort of figured, every controversial deal we should have done. And the reason is because not everyone sees it. And if not everyone sees the opportunity, that means you're probably early to the opportunity, right? If everyone's voting yes, it's probably because the market has accepted this is a good opportunity, and so you're with the herd. That's not always the case, but I think there is a signal there when you have disagreement within the partnership. The other thing I think we've learned is don't over optimize on price. I mean, the entrepreneurs listening will love this advice, but at the VC, don't over optimize on price. If you really want to do the deal, do the deal. We've had situations where we passed on Splunk because, we wanted to pay 90 million, not 110 million, or we passed on Yelp because we wanted to pay 60 million, not 70 million. And then you look back and you say, well, the price wouldn't have mattered, and what matters is you're in the deal. And so in the future, then you look at deals and say, hey, I'm just going to pay the price. I want to be in this deal in an early stage or whatever. I want to be in this deal. And again, it's a have and have nots world. So don't get too wrapped up on price as a VC.
That's great advice. You've been doing this for 26 years. What's the company that you passed on that
20,
still haunts you? The
28.
one where you think 28.
We passed on a lot of deals. I mean, as mentioned, Splunk, I mentioned Yelp. We passed on a lot of deals over the years. It's on a one we passed on. There were a whole bunch of deals as a partnership we passed on. I think Bessemer does it best, produce an anti-portfolio that is the deals that they passed on. As a VC, you're going to have those, right? You're going to pass on deals. What do we take from that? We take that maybe net you should be doing those deals. You maybe should be taking more risk, right? Instead of talking yourself out of deals. And most of the time, when we look back, go, why did we pass on that? Was it a price thing or a market thing, or we didn't think they could get this done or that done? But I think then you become, if you look at all those things and you realize what you missed, right? And there's no call strikes in venture, but there certainly are pitches that you ought to be swinging at because you're going to hit it out of the park if you swing at it, and you don't. And that's a mistake. And so you look back and I think you become more forward leaning then, and you become more, let's start with yes and figure out why we should say no versus start with no and figure out why we should say yes on this. But you go back to the telecom days. There was a whole bunch of deals that we passed on and we passed on Databricks really early. And, now we're in it, but we paid a lot higher price than we could have. So, it's a great company, but you do that. That happens. Look at all the people that passed on Facebook, right? Look at all the people that passed on Anthropic. I think they said there was 20 people that passed on them in the first round.
Yeah. Does that haunt you? Like when you look at these deals, you see them early and then you see them 3 years later at like a 10x valuation. How do you kind of deal with that?
If as a VC, it's not a great feeling, right? You pass on something and then you see it doing really well. What you have to do, and this is a hard one, is you have to not say, well, gee, I missed it, so I missed it. So I'm not going to do the next round or the next round or the next round. What you have to be able to say is, okay, I missed it. I screwed up, but I'm going to fight like hard to get into the next round and actually get in that company. I'm going to end up paying a little more, but I want to be a shareholder in that company. And I think some VCs are really good at that and some are not. I would say that I was not as good at that mentality, but you have to learn to be better at that mentality. You make a mistake, learn from it and move on. We all make mistakes.
It's an ego hit, right? To admit that and then to go back to them and say, hey.
Yeah, I don't know if it's an ego hit. Yeah, it probably is an ego hit, but it's also, okay, what did I look at wrong? What did I analyze wrong? And then you got to figure out what that is. And then, but yeah, you want to go back and, that's why I think when you turn down companies, you always want to turn it down in the best way possible to leave the door open, right? That you can come back to a CEO and say, hey, I was wrong. You were right. I really want to be in your company. That's all you have to say, right? How do I get into your company? And I think the more VCs that did that, the better portfolios we'd all have.
Can you share a couple of examples where you kind of had to do that?
I mentioned Databricks. We passed on, I think it was the second round or something. And we came in much later. We probably should have come in earlier. Yeah. We missed the first round in Nicera and one of my partners went in and we got in the next round. These are all companies that you make mistakes on, we missed Anthropic early and, one of my partners, Ravi Matre, was smart enough to get us in and pile a bunch of money and, several rounds back. So, again, it's that mentality that, hey, you missed something. That's okay. Figure out, how to get back in the company, because we are in a world of haves and have-nots and capital concentration. So even though we missed those Anthropic or that early round, we still invested more than a couple $1 billion into that company. So you do have to park your ego at the side, but I don't think venture capital is a good industry for egos.
Reading VC Twitter, you'd think otherwise.
Yeah, I mean, again, it's a different generation of VC, so I'm going to sound like an old fuddy-duddy, but I don't see why you need to spend a lot of time talking about investments you've made or celebrating investments you've made or the up rounds that they're having. When a company has an outcome, when they get an IPO or get acquired, that's a good time to celebrate it. When your LPs get their money back or their stock back, that's a good time to celebrate it. But I get it. We're in a marketing game. We're in an influence game, and people want to be out there and let let entrepreneurs know that the companies that they're involved with. So I understand why it's done. It's a relatively new phenomenon.
Yeah. And we talk a lot about the wins once they happen, but there's also a lot of companies that you've worked with over the years that you've believed in and that you've supported with everything you've got and that didn't make it. What's that like? How do you kind of deal with the companies that you've been working with over years and years and that ended up not being successful?
Yeah, I mean, you spend enough time in venture, you have some of those companies. The curse of venture capital is you tend to spend more time with the companies that need your help than the ones that don't. But that should tell you something. Try to find companies to invest in that don't need your help. We all want to be helpful as VCs, but the companies that don't need your help are the best companies. But you spend a lot of time with those companies and you want to support them. That's what we're here to do, is support companies. But at some point, you've got to also think about the capital in your fund. And is it better to go into this company that's sort of struggling, or to put in a new company, or to put it in another company in your fund that is doing really well? And that's where, the concentration model and being really smart about how you reserve capital and where the reserves go and makes a difference. The other thing that really makes a difference to fund performance, and I talked about, the buying in price, right? I just don't think the price you buy in at, whether it's 60 or 70 or 90 or 110 or, 500 million or 600 million, I don't think that matters nearly as much as the price that you get out at, right? And what I'm talking about is a company that, if it's an M&A, you sort of get out at what you get out at, unless you have a choice between stock and cash. But generally, when a company goes public, how long do you ride it? How do you distribute it? And makes much more of a difference on the performance of a fund, how you get out than how you get in. So when you go back to, gee, this price seems high for this company, forget about it. If you want to be in the company and you believe that they're going to be a great company, get in the company. And then when they have a, great event or an IPO, think about how you want to distribute those shares in a thoughtful way that's, good for your LPs.
So was there never any kind of emotional stories that companies or founders that you backed that didn't make it? Were there any times like that that really made you feel sad?
Yeah. I mean, it's easy as a venture capitalist not to be as emotional about a company because you work with a portfolio, right? You've got a bunch of bets. Entrepreneurs put all their eggs in one basket, right? Especially founders. And to see a founder do that and spend a ton of time, 10 years on a company and not get rewarded for it, it's tough. It's tough. And again, we just have a different perspective. We work with a diversified portfolio. We are not taking the risk that they're taking, right? We're providing capital, but we're providing capital to 50 different companies in our portfolio. They're providing their own human capital to their company. So I think that's perspective sometimes that's lost on VCs, is that, entrepreneurs are very different. They're taking very different risks than we are. Yeah. And I have a lot of empathy for entrepreneurs, probably more than I should, but I like working with people, I like the relationships you develop with entrepreneurs, and I like to see them succeed. That's, one of the most exciting parts of venture capital is seeing people build things and succeed. We have this guy, Bipul Sinha, is CEO of Rubrik, and he started as a venture partner, associate with us, and then a partner, made some investments, was a good investor. But you could tell he came from the operating world at Oracle, and you can tell he always wanted to build a company. And he went out and he built Rubrik. as CEO. He's done a fantastic job. And just to see something like that happen, that's the best part of venture capital, is when you see individuals like that rise to the occasion, demonstrate leadership, and create so much wealth for so many people and build these iconic, sustainable companies. And we have examples all over the world, right? That's the beauty of it. This is a global phenomenon.
When you're evaluating founders and a company and the market, I've heard this kind of, different VCs look at it different ways. Some think of it as the market and the timing is the most important thing, not the founder or the product. Others think it's the founder, others think it's the product. That's an oversimplification, of course, but what is your perspective on that? What's the most important?
Everyone has a different filter. I think that the answer to that question could differ by markets, right? I mean, what was important about Snapchat? Well, it might have been just the metrics. What was the data telling us, right? I mean, we didn't know if this was going to be a big market. We had no idea. These guys were in college. We didn't know if they were going to be great entrepreneurs or not, but the metrics told us something. But then you go to maybe a more complicated product, systems product or a hardware-based product or robotics product. Have these people done it before? Then you have to start looking at the market, especially on the enterprise side. Markets become a little bit more important than the consumer side. You sort of know what the consumer markets are all about if it works. The enterprise markets are more specific, and so doing that work. And team matters. We're seeing a lot younger entrepreneurs be very successful. So I think that, it used to be when I started in venture 28 years ago, you looked at someone's, the length of someone's resume, and that was a pointer for you. They needed to have a lot of experience. And now it's different. It's now what type of experience do they have, not how many years. And how good are they at what they do, right? And so it's very different. But it's definitely the team. The team matters a ton in venture. You can fix a bad market, but you can go into a different market. It's harder to fix a bad team, and a good team can fix the product, and they can pivot into another market.
What's something that you believe about investing right now that most other VCs would disagree with?
I mean, I've said a lot of things, right? I don't think price matters that much. I think concentration is more important than diversification. I think people would argue with that. I think that I would tend to say yes before I said no. I would always be leaning forward versus trying to get to yes. I'd be trying to get to no. And that's a different perspective. I do think that there's still people out there that are really good at building companies and getting companies off the ground. Certain funds are really good at that, paying attention to those people. It's a different ecosystem. So it's instead of 10 billion, it's 300 billion now. You got to pay attention to the ecosystem, and you got to develop partnerships. We compete with our peers and we partner with them. But at the end of the day, a rising tide lifts all boats. And so I think having good relationships with peer firms and being able to constructively work with them, especially in these companies that need a lot of capital. There's all sorts of things that I believe. Now, I'm just one guy, and I've been doing it for a long time. So, again, some of the newer people to venture have a different perspective. We see some people that have really built fantastic early stage funds now in the last 5 or 10 years that have, very different strategies. So there's a lot of smart people out there in venture. Hopefully there's enough good entrepreneurs, though. That's the thing I worry about. Let's make sure, let's not have too many VCs and not enough entrepreneurs.
Well, if AI does a lot of the grunt work for us, I don't see why we wouldn't have a lot of one.
Yeah, you still need people that have, they have to have the idea, the willingness to take the risk, fundraising expertise, building teams, leadership, all the stuff it takes to build a great company. We just got to make sure we have enough of those people, right? And we're giving them the opportunities. And I see when you're in New Zealand, probably a lot of people that fit that profile in New Zealand. You just got to find them and make sure that they get a chance to do it.
On that point, what is your very interest in New Zealand?
What is my interest in New Zealand? Well, I've never been there. I've heard it's a beautiful country, so it's on the top of my list of places that I want to go visit. And I think I'm going to go there probably October and November of this year. I'm really interested in the ecosystem and the VC ecosystem, startup ecosystem. And I've heard a little bit about it, and I'd love to just see what's going on and see if I can be helpful to the ecosystem. I love watching sort of ecosystems take shape and see how they grow. The US ecosystem is full, it's fully mature, right? You have some ecosystems that are still a little bit earlier. New Zealand is very, very young. It's a very young ecosystem, right? So I sort of want to look at it and study it and just sort of see what's happening. And I'm interested in investing in venture funds, and I'm interested in the fact that I can, through the Investor Plus visa, and I can be, I can have the ability to come here and spend a lot of time in New Zealand and work with startups and invest in VC funds and do some of the stuff I like to do in a beautiful country.
Do you have any thoughts about, I guess, is your interest in New Zealand partially driven by the geopolitical situation that we're kind of living through with the world, the post sort of World War II order, the world kind of fragmenting and countries forming different alliances, and the U.S. sort of taking a step back from being kind of the enforcer of the global order?
Yeah, I mean, it's a good question. I don't consider myself hugely political. I'm not far right or far left. I'm sort of center. My interest in New Zealand is, um, being in a place that is really just emerging as an ecosystem, and sort of the excitement that happens when ecosystems are emerging and forming, being able to sort of see that and maybe even lend some expertise to that while experiencing a beautiful country. Put all geopolitical stuff aside, what's wrong with that? If you had a matrix of the beauty of a country and the stage it was in terms of the ecosystem forming, New Zealand's got to be near the top of that list, or at the top of that list, right? There's other ecosystems forming, but so, I don't want to be a full-time BC anymore. And I'm semi-retired and don't plan on starting any new funds. I help people. I help a lot of funds in the US, emerging managers get their funds off the ground. Why can't I do that outside the US?
Yeah. There was this moment during COVID where people were saying that now Silicon Valley is everywhere, and people moved to Miami or started investing in Europe and other places, New Zealand including, and generative AI happened, and everybody was like, we need to be in San Francisco. How do you think about that? Do you think there's an opportunity to develop ecosystems outside of this kind of epicenter of AI, even if there's this kind of pull towards San Francisco now?
I mean, there's certainly opportunities to develop ecosystems. The problem is it takes a lot of time. And what keeps pulling people back to the Silicon Valley, the fact that generative AI and AI is happening largely in the Valley. Why? Why is that? Is it because of the infrastructure? Is it because of the fact that there's really important semiconductor companies here? There's important universities. There's an important pool of talent. So it probably is not a surprise that AI is centered in the Silicon Valley. It's good for the Silicon Valley. It doesn't mean that we can't have other centers of excellence throughout the world, though. But it takes time, right? You got to have repeat entrepreneurs. You got to have a good educational infrastructure. You got to have some notable companies that contribute to the infrastructure. The fact that you can be right down the street from NVIDIA is probably an advantage for an AI company, right? You know what they're building, you know how to take advantage of it. You can get their help. There's all sorts of, so once you build the ecosystem to that scale that we built in the Silicon Valley, it's really hard to unseat it. Doesn't mean it can't happen. You get too complacent, it can definitely happen. But I think it's really positive that we see all these ecosystems building out, not only across the US, but also across the world, right? In Europe, Israel, South America, Central America, South America, Southeast Asia, China, India. You can go on and on and on. Australia, New Zealand, right? We're seeing all these great ecosystems develop, and that's good. The world is a global market.
And is there, in your mind, is there a formula for these ecosystems? Like, do you need a certain amount of capital, a certain amount of density of universities? Like, what is really important at these very early stages of an ecosystem?
You sort of almost need just a handful of companies to hit. And then the people from those companies start the next generation, and all of a sudden it builds on itself, right? And if you can get that flywheel going, it's helpful to have universities, because universities provide talent, and talent's important. Human capital is important here. But, VC capital is obviously important to getting companies off the ground, as could be government capital in certain cases. But, you want to build these sort of companies that get to a scale, they go public and they're successful. And then, of course, people come from those companies and all of a sudden you have these, in the US, we call them mafias, right? PayPal mafia and always different mafias out there. But you have these, groups of people that then start the next generation of companies. And that's happened in Israel, right? For sure. Happening in China and India, several parts of Europe. And, I think you guys are on the verge of it there.
Yeah. Yeah, definitely. I think in Australia, it's probably Canva that plays that role.
That's right.
And yeah, and in New Zealand, we see a lot of space companies, and that's because of Rocket Lab. So there's this idea of this mafia as well.
And it's interesting because as you have a Rocket Labs and then people start other companies, all of a sudden you can think about yourself as becoming more of a center of excellence in that sector,
Yeah,
right? And then you
absolutely.
can leapfrog some of the other geographies in the world. So this is all good stuff. It's like, early in Israel, security, they brought a lot of security from the defense to commercialize it. And they became really a center of security companies in the world. And so, and they've obviously expanded that to a whole bunch of other sectors now, but that's the opportunity.
Yeah, totally agree. And I think, we can see that for sure with the space industry here. And we're backing a bunch of space companies that we're very excited about. Maybe to go back to your early days at Lightspeed, if you were to start a venture company now, is there anything that you would advise yourself to not do or to do differently?
I have a long list of not to do's. I'm not sure I would, I tell people when I started, if I knew what we had to go through at Lightspeed, I'm not sure I would have done it, but I'm glad I did it. But building a venture firm is different than having a successful fund. It's multiple successful funds. It's building out teams. It's building out your strategy. It's evolving your strategy. It's all that kind of stuff. I think, and I've sort of developed some slides on it for emerging managers, but you should think about your venture firm as a product, right? A product that LPs buy. And your product is described in really three ways: stage, sector, and geography, right? So you might say, okay, we want to be the best early stage fund in New Zealand and early stage enterprise fund or whatever, So that's how you describe. And you sort of have to test the market to see if you have product market fit, right? You have product market fit if you're seeing the best deals in that category and you can win them, right? And then you have to test the market to see, is the market big enough? And the size of the market really is how many dollars are going into early stage enterprise companies in New Zealand, how many venture dollars a year. That's sort of the size of the market. What's your share of it? Can it be big enough for you to put your fund to work in a way that captures the top 10% of deals? And then you have to make sure that you're defensible, right? We talked about the things that are defensible. People are going to, if you're successful, people are going to come after you and compete. And there's going to be other firms, and there's, lots of venture firms in New Zealand competing. It's my advice is, treat your firm like a product. It doesn't mean the product can't evolve. Our product evolved every fund cycle, but you sort of have to look at it and say, with this strategy, can we win? Can we get into the best deals and produce good returns? And if you can't, then you have to change your strategy.
When do you know you have product market fit as a venture firm? Because with products, especially now with AI, you can probably see it in a few weeks when people are starting to use it and your user numbers are growing. In venture, you're obviously playing a very long game, right? And you're saying not only as a fund, but over several fund vintages. When did you feel with Lightspeed, okay, we're winning
product
this?
market fit can change every fund. For us, if I'd say product market fit, your product is stage, sector, and geography. We started as early stage enterprise in the US. Then we added consumer, and then we actually added India and China, and then we added growth, and then we added healthcare, and then we added late growth, global growth. And so every time you do that, you change your product. You have to go back and you have to check. How do you know if you have product market fit? Are you seeing the best deals, right? We would measure the deals we're seeing and the deals that are competitors. We would find a list of competitors, pick 10. Which deals are they doing? Did we see them? Why not? Are we seeing our fair share of deals? Are we getting into the best deals? Are we competing and winning? And that's how you know if you have product market fit. If you're not seeing those deals and you're not getting into them or you're not winning, there's something wrong.
Because the critics would say that you only see if you're winning if you can produce DPI, right? Even if you have markups, it doesn't really mean anything until you return money to your
Well, at the end of
LPs.
the day, that's how we're all measured is DPI by LPs. But when you missed a good deal, right? Or you didn't see something. And so why didn't we see that? what's wrong? Why didn't we see it? What do we have to do different to see those deals? Or why did we lose that deal? How do we then, next deal, how do we do something different to win? Right. And you should look at market share. You should look at what your competitors are doing. We are a product. We sell into a market and we compete against other products, other venture firms. And there's no doubt if venture firm A is in a great company early and venture firm B is in that same company later, venture firm A is going to outperform venture firm B on that particular investment. So you also want to look at your peers and find out, are you in the good companies earlier than them, or are they in earlier than you? So it's all that kind of analytics stuff, and AI can definitely help you with those analytics. You guys should be doing that.
Yeah, that's really good advice. Yeah, Mark is vibe coding all night to build our analytics platforms in the background. So
perfect.
We're working on this. Yeah, just curious. You said you're kind of semi-retired. You're looking to help other venture ecosystems, as you mentioned, but you're also still kind of rooting for Lightspeed, and you're involved with Lightspeed. What do you want the firm to be? Or where do you see the firm in 50 years?
50?
50.
I don't know. Will we have venture firms in 50 years? Will we even need venture firms in 50 years? I don't know. 5 years, is probably about as far out as you can plan for a venture firm. Big firms have to go through generational transitions. They have to keep their eye on the ball. They have to generate performance. They have to make sure when you're working across sectors and across stages and across geographies, you got to make sure you don't, lose momentum in any one of those. If you're doing late stage deals, you got to be really good at early stage. But that's the engine. You can't sacrifice geographies for certain. You got to make sure you're hitting on all cylinders. And so it generally comes down to people, getting great people in your firm and developing them and giving them an opportunity. And I think you have to, in terms of generational transition, you have to make sure that you're getting good young people in and probably giving them responsibility before you might be comfortable, and probably paying them more than you might be comfortable. But that's how venture works today. And I think the older partners like myself need to get out of the way and make room for the younger people to learn, and learn by doing. That's how you learn in venture. So, that's how you do a good generational transition. And we've seen, firms, I think Sequoia has done that very well, and it's hard. There's not a lot of other great examples. So it's hard to do that. So we're all working on that kind of thing. And of course, you want to make sure that you're getting into the notable deals, right? Some of these deals are fund makers. In a deal, in a fund of 50 companies, 2 or 3 really matter. 2 or 3 companies matter. They make the fund perform. So you want to make sure you're in those. But again, it all comes down to people and AI, I guess, in the future. And so, I do spend time with Lightspeed. I sit on some boards still and try to help the team, and we have good people running it, and you want to make sure the young people get a chance to learn and develop their leadership and continue on.
Yeah, Barry, to close out, what's the question you wish interviewers would ask you but never do?
If you weren't a VC, what would you be?
And the answer?
Yeah, I never thought I'd be a VC. So I'm surprised that I've been doing this for 28 years. I probably should have taken the VC class in business school. I might have been better at it. I think I'm doing a lot of stuff with the creative side of my brain. I'm learning how to play the guitar, writing more. I was a really creative kid growing up. I feel like because of Silicon Valley came, I sort of, had to get into tech to sort of stay in the Silicon Valley. So that helped push me in a certain direction. But God, I would have loved to pursue more of a creative career, either in writing or, film or books or music or something. And maybe I didn't, maybe I don't have enough creativity to do that, but I think it would have fed my brain a lot. So I find that in venture, you feed the left side of your brain a lot and it gets overloaded, and you sort of don't feed the right side much. And now I'm spending a lot of time feeding the right side. It's definitely hungry.
Yeah. All those things you mentioned, funny because all those careers are sort of at risk with AI, right?
Yeah. The other thing, I love sports, and how many of us played fantasy football, but man, wouldn't it be great to be a GM of a pro sports team and get a chance to build a team and see how they do? Any sport, right? So something like that would be fantastic. But, there are a lot of similarities to building a sports team and building a venture firm. So at least I got to do that. But, I have no regrets. It's been a great experience, and I love staying in the ecosystem. And I wish you guys the best, and I hope I get a chance to work with you when I come out and meet some more of the entrepreneurs.
Absolutely. No, we're very excited to welcome you in New Zealand in October, November. Thank you. See you soon.
Thank
Bye-bye.
you so much. See ya. Thank you for tuning in to TechMates. If you enjoyed this episode, be sure to subscribe, leave a review, and share it with friends. We'll be back soon with more stories of Kiwi and Aussie founders reshaping the future and disrupting down under. Until next time, keep dreaming big and daring to disrupt.